Hello, everyone. Today, I'm joined by Vas Natarajan, a partner at Accel, a leading global VC. Hi, Vas. Where are you dialing in from today?
Hey, Julien. Calling in from San Francisco today. Thanks for having me.
No worries. Thank you for joining. Is that where Accel is primarily based, or is it a global VC that has offices all around the world?
We are a global VC. We have offices in Bangalore and London as well, although we are primarily headquartered in the Bay Area. So maybe just giving a brief overview on the history of the firm. We started back in 1983 on the East Coast. So our founders, Jim and Arthur, had met at school. Funny enough, they were on the football team together. They were working in finance in New York and just saw a big opportunity to create a preeminent technology investing firm. At the time, there was a lot of innovation being born on the East Coast with what DARPA had funded, with what Bell Labs was doing in New Jersey. They were coming across some really incredible entrepreneurs and saw a big gap to help those entrepreneurs breathe life into their ideas. So they started Accel in 1983. It was originally headquartered in New York, but then ended up moving down the New Jersey Transit corridor to Princeton, New Jersey, which, funny enough, I actually lived in Princeton for quite a while. And unbeknownst to me, I had walked past the office, or I walked past one of the original Accel offices just as a middle schooler, high schooler, when I was growing up in Princeton. But they started in Princeton and ended up moving out west to Silicon Valley here in Palo Alto in the early 90s as more and more great technology companies were getting started here. And in the late 90s, early 2000s, similar to the catalyst for moving out west, we saw a ton of great entrepreneurs starting companies in Europe. And so we launched our Accel London effort and built a partnership out there. And then in the late 2000s, early 2010s, we really in earnest stood up our efforts around Accel India because we had a bet that there was going to be an incredible cornucopia of activity there as well. And that's proven to be super, super successful. So Accel, I like to quip, has grown on two axes. The first axis is geographically. So we followed the talent. We started in New York. We moved to Princeton. We came out west to Silicon Valley. We emerged in London. We emerged in India. The raw material of our business is great, exceptional technical founders. We need to be where they are. And so we have organized ourselves as such. On one axis, we grew geographically. And then on a second axis, more recently, we've grown across stages. So all those efforts that I talked about, our early stage fund in Silicon Valley, our early stage fund in London and India, very focused on seed Series A. So day zero, inception stage founders that were just getting their company up and off the ground. We wanted to be their founding anchor investor. We want to be the first money into those businesses. But we realized a couple things were happening. One, companies were delaying fundraising altogether. So in the era of open source software and cloud infrastructure and customers buying software over the web, you could be a founder starting a software company just using your credit cards or your own personal investment, and you could get to scale, if not outright profitability, on your own investment. And so we were seeing a lot of bootstrap founders that were in some ways skipping the classic seed and Series A stage and going straight to the growth stage. And we thought, why are we constraining ourselves? These are exceptional technologists. We want to work with them as well. Let's figure out a way to invest in their businesses. And so we launched a growth fund in 2008, 2009. And the archetype of deal there is what I described. It's founders that just saw an unmet need in their industry and they decided to just solve it themselves. And oftentimes they were starting in geographies where they didn't have access to local venture capital. So I think of Mike and Scott Atlassian. They had started in Sydney. They were building the business in the early 2000s when there wasn't a mature venture ecosystem in Australia at the time. So how do you fund your business? You really can't fund your business. You have to just rely on customer receipts as opposed to venture dollars. And Atlassian scaled to 8 figures of revenue before we finally intersected them and realized they were building a special company. And so we invested in that business at a much later stage. Qualtrics is another good example. I remember fondly Qualtrics being a classic software package that we used at Wharton when I was there, specifically in our marketing research classes. And that was a company that was started in Provo, Utah. Again, founders bootstrapped their business. There wasn't a big, mature venture ecosystem in Utah, and they built a company that was largely funded by customers who love their product. And when we intersected that business, I think it was maybe 20 to 30 million of revenue at that point. And so again, we realized we were coming across much later stage businesses who, by sheer force of will and quite frankly, out of necessity, they had built a company on their own dime, and we wanted to participate in those businesses. So we raised that growth fund, and that's now a multi-billion-dollar effort for us. Moving even later stage than that, we've witnessed what I call the financialization of technology companies. 30, 40 years ago, a startup may have raised $2 to $5 million before they maybe even went public. I think, I'm trying to remember the stat on Microsoft, they probably raised $2 million, $3 million before they ended up listing for their IPO. Back in the day, there weren't that many opportunities to invest and buy shares in a young, promising technology company. But now, as businesses are getting substantially larger, now as they are staying private longer, there are many more entry points into these companies. We raised what we call our Accel Leaders Fund to help support opportunities to invest in businesses across stages. And that might look like a primary direct investment in a business where the capital goes on balance sheet to help scale the business. That might look like a secondary opportunity where a company has just become so successful and is profitable, and there's an opportunity to execute a tender internally for the employees and maybe some of the older founders to sell some of their shares. And we want to be able to participate in those types of rounds as well. So broadly speaking, we grew across geographies, and then we grew across stages as companies presented more entry points to invest in those businesses, entry points of different flavors. And that brings us to where we are today, which is we're a multi-stage, multi-product, multi-geography investing firm. But at the core of it all is we want to work with the most exceptional technologists in the world who have a deep thesis in their category. And we want to take concentrated bets behind companies we really believe in and have a thesis in ourselves. So we aren't here to buy the index of early stage private technology companies worldwide. We really define ourselves as being thesis oriented, very learned about our categories. We try to be students of the markets well in advance of when we invest. We try to pick the 1 or 2 companies in a category that we think are going to be the disproportionate winners. And then we want to put the might of our firm behind those assets. And that, knock on wood, has gotten us to today and underwritten a lot of our success.
Great. That is an incredible sort of background and history on the firm. And I think leads me to so many different questions. I mean, the first is when you think about Accel becoming this multi-stage fund, being an early investor and seed Series A is a very different job and challenge than being a growth investor. You mentioned Qualtrics and Atlassian, you had 8 figures of revenue to sort of start doing your analysis on, right? It becomes much more sort of like a spreadsheet type of investment, if I could categorize it like that, versus investing in an idea where there is no data to any sort of hard analysis off of. Are those teams separated internally? Like, do you invest along the entire capital stack, so to speak?
It's a great question. It's very tightly integrated internally. And that's probably the one thing that doesn't scale about Accel is we want our international teams, our global teams to be as threaded through the valley as we are through their geographies. We want the learnings that we're picking up from our early stage team to infuse how we think about companies on the growth stage and the leader stage as well. And so it's meant to be one Accel. And that is a non-trivial exercise, and it takes designing the culture and the set of processes inside of our firm. It takes designing those with a lot of thought and intention. On a Monday, as an example, we do have separate meetings for each of those funds. So we'll have a leaders fund meeting, we'll have a growth fund meeting, we'll have an early stage meeting, but We have teams that sit across all those funds. And the charter for us on those teams is to make sure that we're threading insights across our products, because probably one of the best advantages we have to making a growth and a late stage investment is that we have a sense of what's coming across the horizon from an early stage standpoint. And so we can't be making a late stage bet without having a real sense of, okay, but what's some of the innovative or disruptive technology that's coming out right now? And how does that impact this late stage investment that we're about to make? Maybe it means we need to rethink the holding period of a late stage investment because there's something very disruptive coming up from behind that we've learned about on the early stage side. Maybe it means we need to pick a certain type of company, maybe one that's more sales and distribution focused as opposed to technology focused because of upstarts that we've met from our early stage team. So we need to be incredibly well threaded across our firm in terms of the insights and the learnings that we have.
I think you highlighted a great aspect or advantage of a multi-stage fund in that you have this team that's deep into the pipeline of the early stage world that can kind of feed what your later stage investors are doing and have sort of that mutually beneficial relationship. But on the flip side, you also start walking into signaling risk of, say, you have made an investment in a seed or Series A company, and then you don't make that follow-on investment. How do you guys manage that of almost, in some cases, being the creators of your own destiny with some of your early stage investments?
Yeah, that's a great question. We are always attempting to double down on our best companies. It's in our best interest. Our LPs want us to double down on those companies. I have been on the other side of companies that have raised significant rounds of capital at really nice, healthy valuations, and I felt great. We could report a nice little carrying value uptick to our LPs. I could tell my partners, hey, we just raised this big round from this brand name firm. Look at how that validates the business. But then you realize you have to live with that price. You have to live with the expectations implied by that price. And I've seen very organic, exciting, young, promising businesses that have been distorted by those situations. I take those battle scars with me and I try to relay those stories to our founders to help in some ways preserve the innocence of the business. I mean, there's something so pure about 5 to 10 young, really deep technologists sitting around a table, solving hard technical problems, building a product that they're distributing to the world. There's a raw magic to that, and you will never get that back as a founding team. I encourage the companies I work with to take advantage of that moment and get as far as you can before you go out and capitalize yourself in a way that sets you on a certain path. I mean, that capitalization creates path dependency, and I think it's worth being open and honest about what that path is.
Yeah, I mean, it's a super interesting point because I think a lot of people saw, I guess, the tides changing in 2022 of more challenging fundraising environment and saw that to be a negative thing. But I think there's kind of a debate around that, right? To your point of maybe it is healthy to have these smaller rounds and create a more healthy business from a cost perspective also, because I heard a lot of stories of people raising these massive rounds on massive valuations and then completely bloating up their cost structure in a way that wasn't sort of sustainable for a long-term business.
I actually think this is a great analysis to do. Maybe it's something we should do at Accel. I'm trying to remember having lived a lot of those fundraisers in 2019 to 2021 when we were sitting on Zoom and founders had term sheets for hundreds of millions of dollars at multi-billion-dollar post-money valuations. I'm trying to remember how many of those companies actually ended up living up to the promise of those fundraisers. I'm sure there are some that ended up catching up to the mark, but I would guess the majority, the vast majority, were actually hamstrung by those fundraisers. And I think it's something that's still sorting itself out in the market right now. We haven't seen the extent of the pain of the companies that just aren't quite frankly going to make it because maybe they raised at too high a price. Maybe they raised their burn rates or they overinvested in the business relative to where the market demand was. I think all of that is still sorting itself out, quite frankly. And that vintage of 2009 to 2021 will be instructive in its pain. And there's going to be a significant lag to that pain because a lot of those companies, quite frankly, just still have so much money on their balance sheets. And so they haven't had to really pay the piper, so to speak. Is that the analogy?
Yeah, I think that is a bit of the analogy there. And I think it also kind of highlights an interesting point around just like the long feedback cycles in venture too, is that we're still creating effectively investments from 2009. Some of those have probably borne out to this point, but that makes the job all the more challenging. I now kind of want to quickly pivot and talk a little bit about you and sort of your background and how you found yourself at Accel, and then dive into a couple of the investments that you've particularly made in the last couple of years. I think it's always interesting to hear where venture capitalists come from because it's the founder track, the investment track. And so curious to sort of hear what led you to Accel and then ultimately to sort of like the sectors that you now invest in of infrastructure, data, security, some of these more technical products.
Actually, what led me to Accel is a great story about Penn and Wharton and just the magic of serendipity. And if you'll bear with me, I'll tell you how I actually connect the dots here. But I remember I was an undergraduate at Penn. I loved technology. Back in the mid 2000s, software companies, tech companies weren't coming to Penn to recruit. So I ended up doing a summer internship at a firm in New York called Insight Venture Partners. And my goal was to just learn as much about how to build technology companies, how to finance technology companies, because it's a very unique art and science. And I got to Insight through actually a very close friend of mine who was in my fraternity of all things. His name is Arun Matthew. He had been a summer analyst at Insight. He had gone back there full time, and he sort of poked me one day. He just said, hey, why don't you come spend the summer with us and see how it's like, see what this industry is like. Went to Insight, loved it, went back full time, had a great experience. Insight, you are day in and day out sitting in front of the best technologists, entrepreneurs, innovators in the world. You experience the tip of innovation across our global GDP day in and day out. I loved it. It was like drinking from a fire hose, but it was an amazing experience. At that point, my colleague Arun had actually moved on to Accel. And probably by year 1.5, 2, I was starting to think, well, Insight is one way of learning technology investing. Maybe there are other ways. And so I sort of poked my head up and was looking around, and I was probably motivated by other peers of mine that were also in the recruiting process and had done their first 2 years of banking and were starting to think about the next adventure. I was doing something similar, and I just remember I was going down to a conference in Washington, D.C., and I was in the process of interviewing at another firm, and I had an interview that night, but I was in D.C., and we were at a Microsoft technology vendor conference, and I was sort of walking up and down the hallways, looking at all the vendors and just seeing, hey, what's the buzz? What are customers talking about? What are sales reps talking about? You often learn a lot just keeping your ear close to the ground at some of these venues. And at the back of my mind, I was thinking ahead to this interview I had. I think it was that night. And I remember almost being done walking the floors, but then realizing, let me walk this one last hall before I decide to head back to the hotel and get ready for this next interview. So it was this fascinating decision point. I was either going to go grab the taxi and head back, or I was going to walk down this one last hall. And something told me, why don't you just walk down this one last hall, just see what's there, and make sure you do a complete job. I think that was really important to me. So as I'm walking down that last hall, who do I run into but my colleague and close friend from my fraternity, Arun? And I hadn't talked to Arun in probably a year and a half. We'd always just kept in touch via text, but we hadn't really caught up in a while. And we gave each other a big hug, and he's like, oh, I didn't know you were going to be at this conference. And I said the same. I had no idea you were going to be here. And just always thanked him for bringing me over to Insight originally. And then I said, yeah, but I'm kind of getting pings by all these recruiters, and I'm starting to think about what's next. And maybe there are other ways to experience technology investing, and I want to just make sure I get the fullest experience possible. And so I told him, I'm interviewing at all these firms, and what do you think? And he just stopped dead in his tracks. He said, dude, you got to come chat with us at Accel. Like, I had no idea you were thinking about this. Had I gone home that day, had I gone back to the hotel, grabbed my taxi, I wouldn't have run into him. We wouldn't have had that conversation. I wouldn't have gotten pulled into the Accel recruiting process. And now here I am, 16 years later. I hope to run our venture fund, and any number of moments, things that have emerged in my life came from the serendipity of that one moment. And it's always led me to just be really thankful for the serendipity and the doors that do open in front of you. And the path that one follows in their life, it can take any number of twists and turns, but you have to be grateful for the people that have sort of nudged you along the way. And sometimes I sit back and wonder, wow, how different would my life have been had I not walked down that last hallway? it would be radically different, both professionally as well as personally.
Yeah, I mean, it's a great lesson. I had another interview with another venture capitalist, and they mentioned something about the best piece of advice they'd received was always say yes to things. Just kind of put yourself out there as much as possible to get as many pings or as many like serendipitous moments that can create themselves. So
it really is the one thing we met as an example through what I call the Finance 250 class. I don't know what the registrar code for it is now, but it's the Finance Innovation, it's the venture capital class. And that was one of the most impactful classes in my life because it really exposes the importance of thinking in bets, thinking probabilistically as opposed to deterministically. And then within that, the concept of call option thinking. What is a call option? It's an option to buy an asset with an underlying strike price within a certain period of time. And venture capital at its core is buying call options in really exceptional young technical founders at hopefully low strike prices with very long duration windows. And you hope that those call options hit in really big ways. We were the Series A investor in Facebook. We paid $10 million for 10% of that business at a $100 million post-money valuation. And I think as of this morning, it's a $1.8 trillion company. That's a call option that is wildly in the money. And you connect that to just your life. How do you expose yourself to as many call options as possible? How do you build a portfolio of call options that have an opportunity for very high positive variance, that have very long duration windows so that you can see as much of life lived or as much of history emerge so that you have a chance to figure out if that call option hits or not. And that's how we think about our portfolio. We think about when we launch our venture fund, we don't say, hey, we want exposure to this category, that category. We don't allocate capital and try to build to some sort of diversified, efficient frontier. We think about getting 30 to 35 well-priced call options with as much positive variance as possible. So things that can really spike to the upside. And we think about how do we get those call options as much time as we can get them? Because the more time you have, the more opportunity you have to see those positive events. And if we do that right, out of a portfolio of 30 call options, 3 are going to hit in a really, really positive way, and they're going to more than pay for the other 27 or 30 that don't hit. That day in that conference center in DC, I took the call option. I bought the call option. I spent my time. I spent my calories to walk down that extra hallway. And lo and behold, it hit in an enormously positive way.
And here we are. And I want to pivot a little bit into talking about the sectors that you cover and just trying to understand those market dynamics. I think particularly in the infrastructure and enterprise software space, we're at a really interesting time in the market where we have these incumbents who have a ton of market power and a ton of distribution advantages, right? If you think of just AWS, Google, and Microsoft, they're probably in every single company in the world today, almost. Maybe say 95%. The beauty of that is that it's then easy to sell all these extra services. That's why Microsoft is the company that it is today. But on the flip side, it makes it really hard for, say, a young startup who wants to innovate on the data side or doing an application software in name the sector, because they have to kind of overcome this distribution barrier that these 3 large incumbents have. And so I'm curious, is this a unique time in history? Is it that we have these incumbents, or is this just like par for the course and distribution's always a challenge, or it's actually for XYZ reason, distribution's not actually that big of a challenge for these smaller startups?
Absolutely. I'd say it's all the above. There's no perfect zero-sum answer for you. On the one hand, we have incredibly well-entrenched incumbents that have large books of businesses that can, quite frankly, replicate the functionality of a startup and almost immediately bundle that into an existing sales contract that they have with an enterprise. And so our founders are always contending with that. But at the same time, look at OpenAI in the past 3 years. I mean, this is a business that went 0 to low single digits billions of ARR in the span of, 36, 48 months. And they did that in spite of there being large incumbents with incredibly well-entrenched advantages. So I think the learning, it's a bit of an overgeneralization, but the learning is always, there's an opportunity to do things differently, think about things differently, package things differently, that either connects with new users of software that aren't beholden to incumbents, or that even attracts customers that are working with those incumbents, but you're just able to do something so magically different and at such a cheaper price point that they have no choice but to switch. And I love companies that are tackling both. It tends to be that for us on the early stage side, you're more often finding companies ignite by doing something very, very different for an entirely new audience. I'm on the board of a company called Gamma, which is in the presentation AI space. And they have a much broader vision beyond presentations, but at its core, they said, look, people have all kinds of long-form content. Maybe you're a student and you've written a paper. Maybe you're an investment analyst and you've written a one-pager on a stock that you're thinking about. Maybe you're a sales rep and you have some notes that you've written about a sales prospect that you're ready to pitch on your new product. Whatever it is, there's all kinds of business logic that has been encoded inside your company. And how do you expose that to a well-formatted, really beautiful presentation so that you can communicate that to the world or to whomever your audience is? And Gamma uses all of the innovation we're seeing in the AI world right now. So they use all the models, they use all the generative AI technologies, and you can give it a paragraph, couple paragraphs, you can give it a document, and it'll generate you a beautiful, beautiful presentation. And today, admittedly, they aren't really working with folks that have lived in Office 365 inside of the Microsoft suite that have all of their assets and their content and their data sitting in the Microsoft cloud. They're living with brand new people who are maybe just entering the workforce. Maybe they're students at Wharton that are giving a presentation to their class. They're targeting this groundswell of new users that aren't beholden or tied to an existing product, and they're saying, hey, we want to be your day zero productivity tool for presentation development. But increasingly, those new users are sharing their content with people who have grown up in Office 365 or Google Slides, and they're showing them how magical the product is and how easy and simple it is. And increasingly now we show those folks showing up in our funnel where it's like, oh, hey, I just saw a Gamma. Our intern or our newest employee presented a Gamma internally, and I just realized how amazing this service is. And I don't want to live in the four walls of PowerPoint anymore or Google Slides anymore. I'd much rather use a simple service like this. And it's a bit of a cliched framework now, but it's incredibly powerful. But the Clayton Christensen framework around the early adopters, the early majority, I think that absolutely still holds in our market. We always want to find de novo users that are just coming online, that want something day zero, and we want to activate with them and then spread from there. And that's a long-winded way of saying incumbents will always be there. They're always going to be entrenched. As a startup, you got to find your attack pattern. That attack pattern is often going where the incumbents aren't today, but then eventually hopefully you're doing something that the incumbents can't do because they are stuck with large revenue lines that are supported by doing things the way that they've always done them. And if you can show up with something that's fresh and novel, customers are very software literate today. 10 or 15 years ago, they weren't that software literate. You probably only used a handful of applications internally, and so you didn't really have deep expectations around the delightfulness of your product. But I think that's very, very different today. We've all grown up with consumerized software. We grew up with the Apple ecosystem and Spotify and tools like Superhuman and just these really delightful applications that have really radically changed our expectations around the types of software we want to use in the workplace. If you can show up with something that's beautiful and engaging and helps get you the job done in as quick a time as possible, I think people are more than ever willing to switch. And that is the advantage of a startup. It's to do something radically differently at a much cheaper price, starting first with an entirely new audience, but eventually working your way into where the incumbents are.
Totally fascinating sort of like way to think about. Oftentimes you almost want to hear people go after a big market that already exists in your mind. It's like, okay, doing something that's like kind of already out there, but slightly differently. But it's interesting to sort of...
I'd say all of the best companies we've invested in started with markets that frankly didn't exist. They were very small and the market underestimated how large it was going to become. There's a great Buffett line. You really only make money when you are non-consensus and right. If you're betting on an existing market with well-entrenched incumbents, those companies can work out. We've seen any number of businesses Look at an Arista technology. Arista is a $150, $200 billion networking technology business. They were started in an era when Cisco was and still is the dominant flavor of networking equipment in the enterprise. They went around the valley and pitched a radically different approach to delivering network functionality for enterprise data centers, and they were able to explode by challenging the incumbent head on. That archetype of company can work. Now, it requires a very different type of founder. It requires someone who has been deep in the domain, someone who's lived and breathed the requirements of those customers, maybe someone who has a Rolodex of those customers already. You have to find the right founder market fit if you're going against the incumbent head on. If you're not going against the incumbent head on, if you're defining a new market from scratch, it just allows us to invest behind a much wider range of founders. It doesn't have to be the veteran who's lived in the space. It ideally is someone who is much more naive in a good way, by the way, but much more fresh-minded about a category in a space, who is willing to invent and who is willing to do the things that others aren't willing to do.
Almost unbothered by the incumbent in terms of just unwilling to do anything and sort of have a very open mind to innovation.
Unbothered by the incumbent and almost dismissive of the incumbent altogether, to say, oh, well, the incumbent's actually in the wrong market. They should be doing something else altogether, and no one's there, and so I'm going to go there. And folks often ask, why don't we fund older first-time founders? And we do. We absolutely do. But the advantage of being a young first-time technical founder is you're just unencumbered by all assumptions. You aren't seduced by, oh, hey, Cisco has billions of dollars of revenue in this existing space, or Salesforce has billions of dollars of revenue in this existing space. You don't even think about Salesforce. You didn't grow up with Salesforce, quite frankly. You don't care about where they are. You have an idea about something entirely new that doesn't exist, a market that doesn't exist, where those customers are arguably going to move off of or redirect their spend altogether into a new category in space. And I'd say the majority of wins in the valley, the majority of equity value in the valley was created by those types of founders. But again, both absolutely can win.
Yeah.
And we try to do both if we can.
You started to talk about AI and the new types of businesses that are being created, like Gamma. And when I'm thinking about where to invest in AI and like where to find lasting value, I think one of the concerns that I have is that AI is great because it can do everything, but it also means that it could always come for a different type of business. So how do you sort of think about, when you're investing in AI space, investing in something that's not just like ChatGPT wrapper, and that actually is creating lasting value, that has a moat, that won't be disrupted by the next large LLM that can just do it automatically by itself?
This is the pressing question we face every day. The rate of innovation has spiked so significantly that even as a founder, the tectonic plates are shifting under your feet in a more volatile way than ever before. You have to be really, really thoughtful about your core value proposition and how you persist. I think you're absolutely right. Now, what persists? I don't have a great answer for you on what persists in terms of technical value, but I do have a hypothesis around what persists on other dimensions. And to me, what persists is its usability, its UI, its UX, its brand, its story, its taste, its aesthetic. It's the look and feel of your product. You take a Gamma as an example. Gamma under its hood is obviously powered by any number of incredibly valuable foundation models. The value that Gamma is delivering is, how do you package all of that up? How do you remove complexity away from the end user? How do you give them as delightful of an experience as possible? How do you polish every pixel inside of that application so that you want to live in that service? You don't mind spending an hour or 2 hours in their product, getting the presentation into the shape that you want it to be in. You love inviting people in to view the Gamma that you just made. There are a number of great companies in the Valley right now that at face value, you could say, oh, wow, this is just a wrapper around someone else's model. Absolutely. But I would submit that the companies that will endure are actually, they're just moving the goalposts around what differentiation actually means. It doesn't actually mean being as technically differentiated from an application or software logic standpoint, but it actually is going to mean being differentiated in terms of the interface, the brand, and the look and the feel of that product. And those founders are working tirelessly day and night to shave away complexity in the software itself, to polish every pixel, to tell the most magnetic and exciting story, to deliver and distribute the product as broadly as possible. I think in many ways, the core skill sets of a great founding team will be a blend of technical understanding, but also some sort of humanities understanding. There's a great company we're an investor in called Linear, which is in the general project management space. So they help software teams build software. And the founder of that company comes from a design background. He doesn't come from a software background. Now, he knows software, and I'm sure he could be dangerous in a coding environment in an IDE, but he infuses that company with as much of his design spirit as possible. And he is so thoughtful about how his company is consumed, not just at a product level, but also branding, messaging, interface, social. There are so many things he really double clicks on to make sure that that company and that product stands apart. And I would submit that that type of thinking, that humanities-oriented thinking, is going to be a critical phenotype that will need to be expressed in the best companies over the next decade.
Yeah. Just a fascinating note to end on, because I think everyone's trying to understand what does this AI revolution mean for people, for jobs. I think it's especially for us at business school, constantly thinking about like what are the skills that we're going to need tomorrow to be successful. So I think a really interesting takeaway. And thank you so much for joining the podcast, Vas. I really appreciated you coming on.
You bet. You bet. Great to meet you guys. And thanks so much for taking the time.
Cheers. Thank you.